From New York City for our viewers worldwide, I'm Dani Burguer in for Jonathan Ferro. The AI hype cycle lives another day, despite strong labor market data that's putting yields higher. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, futures in rally mode following NVIDIA's blowout results. Treasury yields jump with jobless claims falling to 1 month low. As investors look past the Fed's hawkish tone from the minutes. But we begin with the big issue NVIDIA delivers.
What a sensational set of results from NVIDIA.
This is really the earnings heard around the world.
I'll do my best to sort of contain my enthusiasm.
It seems each quarter they continue to surprise.
It's kind of crazy.
The only result that was going to be acceptable was not only a beat, but a substantial beat.
This is a company that continues to execute and completely blow away everybody's most robust forecast.
There is great momentum there.
People are beginning to wonder how many consecutive quarters can this company continue to run with.
The big question has been, how long can this continue?
There is sort of a consensus in the industry to put some competitive pressure back on NVIDIA.
The competition has never been more fierce than it is right now for NVIDIA, but they have a huge head start.
This tidal wave of spend, it's coming to the rest of tech. And in our opinion, that's going to continue to fuel this tech bull market.
The equity market's sort of really nicely sort of set up from here.
This AI party, it's just getting started.
Well, let's continue the AI party. Joining us now for more on this is Bloomberg's Alex Webb. Alex, 265% increase in sales for the quarter, 400% increase in data services. How should we be thinking about these numbers?
Well, these numbers are sort of following the trend that we've seen over the past year or so, ever since ChatGPT was released as a beta to the general public. The thing that was most significant probably about these numbers was the outlook. And this is on two levels. Firstly, the outlook for the quarter that we're in right now, that will end at the end of April. The market was looking for $21.9 billion in revenue. The company is predicting $24 billion in revenue, give or take 2%. But more significantly than that, one of the reasons that investors have perhaps been a little bit skittish about NVIDIA at times, we saw a little bit of a sell-off before the numbers were announced, is because it only forecasts 1 quarter ahead. And as we know, the semiconductor industry can be incredibly volatile. Demand and supply, they're in a very careful dance that can, inside a few quarters, create massive ructions in the industry. Jensen Huang, the CEO, said on the call that he expects this demand to be continuing on the similar trajectory through 2024 and 2025. And that is something that is incredibly good news for investors and one reason that we're seeing such a pop in the pre-market.
Alex, you got to feel bad for whoever sold NVIDIA shares at something like $650 yesterday in the worst of it. Alex Webb, thanks so much. And along with the comments Jensen Huang made that Alex was referring to, he wrote in a statement, quote, accelerated computing and generative AI have hit the tipping point. Demand is surging worldwide across companies, industries, and nation. This quote in particular got everyone excited. Joining us now to discuss, who I'm sure are equally excited, is Seema Shah of Principal Asset Management and Daryl Kronk of Wells Fargo. I got to be honest, this kind of feels like Barbie. I feel like I'm going to get hate for this, but like so much hype around it. You can't go anywhere without talking about it, but it's like, come on, we've seen the movie and know how it ends. Can we please get past it? But Seema, is the hype here to live another day? Is this the tipping point and we're going to have to deal with another one of these AI cycles?
So yes, good afternoon, Dani. I think that we're quite in line with this. Yesterday's results were quite honestly, they're quite awe-inspiring, and you can't deny the impact that it's having across not just in the US market and the US tech sector, but actually globally. And I think one of those reasons is that people are really buying into this idea that it isn't a tipping point, that there are going to be significant benefits, not just to those companies, but across other sectors which maybe yet haven't seen kind of the jumping on the piggyback bandwagon that is AI at the moment.
Daryl, is this the tipping point, or are you tired about talking about NVIDIA?
Well, not yet, Dani. Good morning. And I do think it's really fueling, it's not just the earnings and sales beat of the company and just the eye-popping results, but it's the sentiment it's creating, right? It's fueling this kind of fear of missing out for the investor that we are at this tipping point and that things are going to keep moving higher and higher regardless of valuations and regardless of what's prudent to pay, for the next dollar's worth of earnings. So I do think it's spilling out. I would welcome the spill out, quite frankly, because what we really want to see out of this market to make the rally both durable and these new all-time highs sustainable is a widening of breadth, right? That was absent in 2023. And so if we can get maybe NVIDIA as a lever to help us widen out that breadth into other industries, things like industrials, things like materials, places where there's tech plus. I mean, semiconductors, I just went and looked this morning, semiconductors, not just tech, we always talk about infotech and the Mag 7 and the percentage of the index, but semiconductors have gone from 2% a decade ago to 10% of the S&P 500. That's just parabolic growth of that industry or sub-industry.
But Daryl, in the meantime, while we're waiting for this market to broaden out, I've talked to a lot of investors who say NVIDIA looks like such a great company. All these AI names like Super Microcomputer, those types of companies, they look like great names, but they have rallied so much. I am scared to get in it now that I will be left holding the bag. I am too late. What would you say to investors? Are they too late if they're not already in?
Well, we do think valuations in that space are stretched here, and history teaches you often that reversion to the mean happens. So I guess I would wait for, if I'm not in them, if I don't have kind of a full portfolio allocation, I would wait to be an active buyer here because I do think you will see a pullback at some point. We know that when you start pushing the S&P broadly to 22 times earnings, which is where we are today, that's in the 90 to 95th percentile of where it's traded historically. And when that happens, history teaches you the 12-month forward returns are about 0% return. So history's not on your side to chase from here. I think you'd want to be a little more disciplined and wait for a better opportunity, Dani.
Well, Seema, it seems like the market's not waiting this morning. We're rallying. You can see on your screen 1 1/3% for S&P futures, NASDAQ up 2%. But we are back in the land where it seems like equities don't care about higher yields. We'll get into some of the macro data in just a little bit, Seema, but are we back in the land for at least equities? Fundamentals, earnings matter more than what rates are doing.
So I think it depends which bit of the market you're looking at. So clearly, if you're looking at the Magnificent Seven, that what the Fed's doing is entirely irrelevant. But for the other parts of the market that have still been quite unloved, they do need to see those Fed cuts coming through. Now, we are quite optimistic they will come through in the second, or at least around the middle of this year, which is why we think there's going to be a broadening out of that rally. It's just that today, of course, anything from the Fed is almost irrelevant because the market is driving off the back of a lot of that sentiment, very kind of positive news that we've seen overnight.
And at the same time, Seema, you talk about this wall of cash, something that could fuel risk assets. It's $6 trillion still sitting in money market funds. It has been remarkably sticky. But my question, Seema, is how do we know when that money comes out, which way it will spread, that it'll be evenly spread? Who's to say it's not just going to continue to chase the current market leadership?
So it's a great question. It's something that we're really trying to delve deeper into. And look, it's going to be difficult to know exactly what the timing is going to be when all of that cash floods out. But I think from an investor standpoint, as you were just hearing, parts of the market are really extended. They benefited significantly last year because there was so much caution around the economic backdrop, so many question marks around what the Fed was going to do next. But at some point this year, you're going to have answers to a number of those questions. And investors should be looking at areas which have been fairly unloved, where the valuations are quite attractive and that typically have done well when the Fed is cutting rates and there is a soft economic landing, of which there are many. So actually, we are expecting to see that flood of cash go into areas such as the small cap space, the value space, other sectors that haven't enjoyed such a strong ride as we saw in 2023.
Daryl, that's not too unlike what you were saying, this idea that parts of this market are extended and the rally can broaden out. How much of that will be aided by the cash currently sitting in money market funds?
Certainly some of it, Dani. I mean, obviously there's some of it that's waiting to come back in the market. But I don't know that I think people extrapolate this idea that $6 trillion is going to have to find a home either out on the yield curve or in equity someplace. A lot of that is bank deposits that are sitting there for cash reasons, and they've just sought out higher interest rates. I do think it's interesting when you think about the macro environment. What was a little bit under discussed, I thought, of the Fed meeting minutes yesterday, which NVIDIA is consuming all the oxygen in the room this morning, is that the Fed is continuing to move towards slowing down quantitative tightening. And if you go back to 2022, right? The Fed's balance sheet was $9 trillion. Today it's $7.6 trillion. So $1.5 trillion coming down. If you keep running on the same pace this year, you'll be sub 7 on the Fed's balance sheet. That's tightening, right? So the Fed, we keep talking about the Fed easing policy and lowering interest rates, but the reality is they're holding rates where they are, and they're continuing to tighten by shrinking the balance sheet in today's world. So nobody's talking about the other side of that tightening policy of QT right now. Everybody wants to talk about when do rate cuts start and how many rate cuts exist.
Seema, are you talking about it? Are you and the team talking about this QT question and de facto tightening, as Daryl was saying?
So I think it's something you have to talk about. You have to be considerate of it. We are expecting the Fed to stop that shrinkage of the balance sheet. I think that they have to tread very, very carefully. We know the financial strains pick up once that balance sheet shrinks too much. And it's something that, as I said, the Fed will be very cautious about. So actually, we're not too concerned at this stage in terms of that tightening mechanism, because we do think that the Fed will try to avoid any of the kind of negative repercussions that can inevitably spill out to the broader marketplace as they continue to pursue that policy.
Well, there you go, Daryl. Someone is talking about it, but maybe not worried about it. Thank you both, Seema Shah and Daryl Kronk. Stay with us. Much more to discuss. But first, let's take a look at some of the stocks that are moving ahead of the opening bell. Here's Abigail Doolittle.
And not surprisingly, Dani, we've got to start out with that big one, NVIDIA. Shares popping by more than 10%. This, of course, on that blowout quarter, poised for the biggest gain in 9 months since that initial blowout quarter and guide last May. The company right now, the stock potentially making a greater than $200 billion market cap move on that beat and guide for triple-digit growth and on the top and bottom line. Interestingly, this is one stock that is trying to overtake the uptrend that it fell below over the last couple of days. It's going to be interesting to see how it trades as the day goes on, but it's certainly lifting the tide for other chip companies. Take a look at Supermicro Computer, also up 11%. To the downside, though, Rivian plunging down 20%. They, of course, cut their production guide for the year to about 50,000 vehicles from greater than 80,000 vehicles. They're also cutting 10% of their salaried staff. Cash of more than $7 billion. That's less than estimated. That stock plunging down about 20%, Dani.
Abby, thanks so much. Abigail Doolittle there. Coming up, the Fed is warning about cutting rates too quickly.
And in Fed policy, there are risks on both sides. And so you wouldn't want to attach a zero probability to the fact that they may need to hike if inflation moves up.
We're going to get deeper into it. The reaction to yesterday's Fed minutes next. This is Bloomberg.
And in Fed policy, there are risks on both sides. And so you wouldn't want to attach a zero probability to the fact that they may need to hike if inflation moves up, which they don't expect and we don't expect. But yeah, they think they're done and they probably are done.
Done tightening, but are they close to cutting? The Fed minutes revealing most officials are more worried about cutting rates too quickly than keeping them high for too long. Then we got jobless claims declining to the lowest level in a month, reinforcing expectations that are exactly that they won't be cutting rates anytime soon. Bloomberg's Michael McKee joins us now to break it down. Mike?
Well, Dani, there's two things to note about the jobless claims for the past week. One is that they were taken during the week that they do the February jobs survey, which could mean good news. The other is that it was also President's Day in the United States, and so the jobless offices were closed for a day in most states, and so we may not have seen a true representation. But the point is, last week before the last week before this one was at 213, still a very low number. So jobless claims are suggesting there is still ongoing strength in the labor market. But as you mentioned, the Fed not in a hurry to do anything about it. They're not going to raise rates right now. In the minutes, they said that participants judged policy rate was likely at its peak for this tightening cycle. They're not cutting rates soon either, though, because they're keeping an eye on inflation. Remember, they didn't see the CPI numbers before this meeting. Most participants noted the risks of moving too quickly to ease the stance of policy and emphasized the importance of carefully assessing incoming data and judging whether inflation is moving down sustainably. A couple did point out downside risks to the economy if they go too long, but nobody who's spoken since this meeting has suggested that the downside risks are becoming predominant. And as I mentioned, this is the CPI Supercore in the minutes, and in several other members who have spoken since then's comments, they've talked about the fact that non-housing service in price inflation was expected to go down, but it went back up last month, at least in the CPI, significantly. And so it leaves open the question of whether there needs to be more restraint put on the economy. But for right now, it doesn't seem to be that's where they're heading.
Well, that's enough to send yields to year-to-high dates. Michael, thanks very much. Bloomberg's Michael McKee. Seema Shah and Daryl Cronk are still with us. Look, Daryl, how much importance do you put on the data that we've been getting? Today, it's another strong labor figure. It was CPI and PPI. Is it a trend yet, or are these still one-offs?
No, I think this is still a one-off. I mean, the trend is certainly directionally to the downside on inflation. We've brought it from 9% down to, let's call it 3% or maybe sub 3. Core is still a little too hot, and super core is still too hot. What's interesting and what we have to watch for, Dani, is if you look back over the last 10 weeks or so, gasoline futures are up about 12-13% as higher energy prices, higher crude oil prices have filtered through. So, history teaches you that when that energy starts to move up, if food prices even hang where they are, and Mike's point, which is the correct one about services, which is 70% of the economy, if that pricing pressure doesn't abate, then I do think that you could have kind of inflation oscillate here for a while, meaning it's not going to go up materially, but it's certainly not going to keep coming down to the rate it has been and get down to where the Fed wants it to be at a target rate.
Right, and that's a great advertisement for why yields and bonds will continue to be volatile too. Seema, do you see it the same way, that yes, the trend is lower, but it looks like this getting there? It's an oscillation down to that lower trend.
Yeah, I would broadly agree. I mean, like January, a lot of the data that we're looking at the moment is a January base. We need to see if this is extended into February, and so that there's no seasonality may be confusing things. But I would agree overall, the thing that we're expecting is that the journey down back to 2% is going to be very rocky, volatile, and quite clearly quite frustrating as well. But from the Fed perspective, that isn't reason to hike. That's a reason just to keep rates at this level for a little bit longer, which is why the March numbers, the March expectation was seemed very optimistic to us, and why a mid-year number seems to make more sense. Now, if on the other hand, over the next month or so, you were to see another blowout jobs number, another very high CPI number, which is really driven by that non-housing services, well, then I think there is maybe some cause for concern, and the Fed will inevitably be having some discussions around, and the market will start to be maybe speculating, putting a little bit more probability onto the chances of a rate hike. But for the time being, we're sticking with that forecast that June is the first date for the rate cut.
Well, Seema, Torsten Slok from Apollo had been writing today that part of what's making it harder is the Fed themselves. He wrote that, quote, the last mile is harder, not because of some structural feature in the economy, but because of the Fed turning dovish too soon, triggering a reacceleration in growth and inflation. That is why the Fed will keep rates higher for longer than markets expect. Seema, what do you make of that? Is the Fed making the job harder for themselves, or even starting that cut talk?
It's an interesting perspective, and actually I have to agree to some extent, because back in October when Powell suddenly adopted a more dovish stance, that didn't help things. It certainly assisted in a further loosening in financial conditions. It inspired markets to rise even further. So I think there is some truth to it, and maybe there is some regret, and you certainly have seen the number of Fed speakers over the past couple of months sometimes walking back a couple of comments that had come out from Powell. But I think that, over the last 18 months, we have also heard them repeatedly refer to the 1970s experience where they did cut rates too soon. and then that triggered another rise and a new peak in inflation. So I think that caution stays with them, and it probably means that they are going to be a little bit slower to hike. And I think the last month's data was probably a timely reminder for them.
They're not the only one talking about the 1970s. Daryl, Marco Kolonovich over at JP Morgan was out with a note saying that it's 1970s stagflation, that we're underpricing that risk. Now, I should just be very clear, Marco has gotten some market calls very wrong over the past year, but ever the contrarian, he's out with this one. He says, look, it could be stagflation, and that means fixed income outperforms and stocks are pretty flat. What do you take of that?
I still think the bar is pretty high for stagflation. I mean, stagflation means you've got to have inflation accelerate from here, or at least stay high and elevated while you get de minimis growth, right? And so what we've been talking about here lately is not economic growth rolling over and becoming problematic. It's simply, it's chugging along faster or better than expected, certainly in the U.S. That's not the case globally. I think stagflation is a conversation of what's happening in Europe right now and maybe even select parts of Asia, but I don't think it's a conversation of what's happening here. I think what people have to do is you have to define what is a soft landing. What's the Fed been trying to achieve? And a soft landing to us is supply-demand balances in the economy, balance out, inflation comes down to target, and then interest rates end up at neutral. And the question is the last one, where is neutral on R squared? People are arguing that's too, R squared is too high, or R star, not R squared. R star is too high and needs to come down, and the Fed needs to just take a little bit of its foot off the accelerator on the tightening path to make sure the economy soft lands here.
I was about to say, Daryl, I've barely wrapped my head around where R star is. I don't have time for R squared to learn what that is. Seema.
Sorry. Yep.
Seema, I want to wrap it up here. We unfortunately have less than a minute, but I was struck by you saying that alternatives provide important diversification against traditional equities and fixed income. What should my alternatives be?
So first of all, the reason that it's important is last year, because inflation was coming down, you did see investors turn away from alternatives, the inflation protection part of it. And I think now we're remembering that inflation is by no means dead, and there's still that importance of having that protection in your portfolio. So things like infrastructure, commodities, natural resources, those are the areas that we still think deserve a place in the portfolio. Maybe it doesn't do as well if there's a significant equity market rally, but I think we have learned in the last 2 years that there's always a risk that inflation starts taking off again, particularly with the geopolitical factors coming through this year.
Right, and hopefully we learned our lesson of the last few years of what bonds can and can't do. Seema, Daryl, really appreciate your time. Seema Shah and Daryl Kronk there. Coming up, we're going to get in your morning calls, and later, why all stocks aren't created equal. We'll be speaking with BlackRock's Jean Boivin, making the case for mounting dispersion in the equity market. That conversation still ahead here on Bloomberg. This is the countdown to the open. I'm Dani Burguer in for Jonathan Farrow. Moments away from the start of trading, it's the tide that lifts all boats, NVIDIA helping us get to the highs of the morning. NASDAQ futures, they are at 2%. Even small caps are doing okay, up about a third of 1%, but we're 1.3%. Thanks to what Goldman Sachs has called the most important stock in the world. HSBC, though, says NVIDIA, they won't be able to repeat it again. Maybe now's not the time to buy. Meanwhile, cross-asset oscillating back and forth between gains from the euro thanks to hot French PMI data this morning. That gets undone by strong labor market data. Means that the dollar's little change. Your 10-year yield little changed, also 4.32%. Yields touching about the highest of the year, while NYMEX crude, $77.75. The one stock everyone is watching this morning, and let's be honest, maybe tired of talking about, but we have to talk about it. NVIDIA delivering blowout results and adding roughly $250 billion in market cap this morning. That is the biggest one-day increase on record. Bloomberg's Alex Webb has more. Alex.
Yes, the numbers were quite extraordinary. Analysts and investors seem to be running out of hyperbole in how they describe NVIDIA. Of course, the numbers themselves are impressive. The forecast, which is for the quarter we're in right now, the one that will end at the end of April, That was $2 billion ahead of what the market had been anticipating, about 9%, a meaningful number. But almost more importantly than that were the comments from Jensen Huang. Because NVIDIA only forecasts 1 quarter ahead, that can create a little bit of skittishness among investors. They are not entirely sure how long this run is going to continue, whether NVIDIA can continue to beat expectations again and again. What Huang said on the call was that he expects this trajectory to continue through 2024 and into 2025. That seems to provide a huge amount of relief to investors, and it's perhaps one of the reasons that we're seeing such a pop in the shares today.
Yeah, I mean, the decks were cleared earlier this week with the sell-off, so why not dive in now? Alex, thanks so much. Of course, it's a very different story for Rivian this morning. Shares getting hammered. They delivered a disappointing outlook along with a plan for another round of job cuts. Bloomberg's Abigail Doolittle has the details. Abby.
To its worst day on record, not so many years because, of course, they IPO'd back in 2021, but right now down more than 80% from that IPO level on that outlook that you were talking about. They're talking about 57,000 vehicles to be produced this year versus the estimate of greater than 80,000. In addition, cash is at $7.86 billion relative to what was expected at 8.74%. That's significant given the fact that this is more of a startup developmental stage company with supply chain snarls. Uncertainty for consumers is being blamed for the production cut and the 10% cut of salaried workers. It's not just Rivian that's down, though, today. A very interesting story is developing this morning, Dani, and that, of course, is the fact that we have AT&T down on a report of wireless disruptions across the country, trending on X. Some are saying that they even had terrible service on AT&T yesterday. Outages were reported in cities including New York, Houston, Atlanta, Miami, Chicago, and Dallas. Customer service representatives for AT&T said on X that they had confirmed an active, quote-unquote, active nationwide outage. The cause is not clear, so they're working to fix it. Tough to fix it if they don't know. What's also very interesting, on Twitter, the top trending, or on X, I should say, former Twitter, Verizon, then outage. We also have nationwide. But Verizon around 8 o'clock said that their network is operating normally, and T-Mobile, they said something similar in the fact that, I'm just waiting for the headline to pull up, their mobile network did not have an outage, yet users seem to be experiencing something different. So this is a fluid situation. I'm sure we'll be reporting it throughout the day, but very interesting, in fact. And the stocks, for the most part, are lower.
Yeah, one of those weird days where you can be like smug for what type of phone service you have. Abby, thanks very much. She mentioned Rivian now hitting the lows, record lows, with that sell-off after the job cuts. Let's stick with earnings. Etsy results missed estimates. The company adding insult to injury, saying it's having a, quote, slow start to the first quarter. Bloomberg's Katie Greifeld has more. Hey, Katie.
Hey, Dani. Yeah, it's a familiar story at this point in earnings season. The fourth quarter actually wasn't too bad, but it's the outlook that was disappointing, and you're absolutely seeing that in the shares this morning. To get into the specifics here, fourth quarter revenue came in at $842 million. That is above the estimate of $827 million. So a beat there, but it was that guide that was pretty cautious. The company said in its shareholder letter that gross merchandise sales for the first quarter of 2024 currently estimated to decline in the low single-digit range on a year-over-year basis. The company did say that it expects that its marketplace will improve as it moves through the rest of the quarter, but it also did note that if our trends fail to improve as we currently expect, this could become a mid-single-digit decline. So there you have it, pretty cautious there. Jefferies cutting its price target, also noting that additional competition from the likes of Temu and Shein, it makes this firm less confident that actually it will improve as expected. And again, you take a look at the shares currently down about 7% on the heels of that.
Katie, thanks very much. Katie Greifeld there. Now, finally, let's take a look at the cruise line stocks. They are up. Royal Caribbean raised its annual profit forecast. It did ease investor concerns over slowing demand. Simone Foxman's with us now. Hey, Simone.
Hey, Dani. Yeah, the last time we got an outlook from Royal Caribbean on its 2024 performance was just 3 weeks ago, February 1st. Now the company says bookings have exceeded the company's initial expectations. Right now is the time when cruise companies offer their best deals all year, what's called wave season. Royal Caribbean saying it is the best wave booking weeks in the company's history. They are seeing strong demand all 4 quarters of the year, according to this statement, especially bookings for the back half of the year, much better than they were last year. And part of this is because of some of the higher price points on these bookings that we're seeing. All of this allowing the company to boost its earnings per share projection by 40 cents for the year to $9.10 to $10.10. 15 cents of that, it says, is going to be driven by that first quarter revenue. This was allowed the company to be upgraded by Moody's, now just 2 notches below investment grade. The company's very much been trying to get back there. We've seen that concern about demand for these cruises after we saw a strong recovery last year and pretty stunning performance, 161% gain by Royal last year. But Stifel says this should put to bed any bear thesis around cruise demand or pricing weakening. We'll look at this, especially as we look ahead to Norwegian Cruise Line's earnings next week. Dan.
Simone, appreciate it. Now let's get back to the broader equity market, because the S&P up more than 1% out of the gates, at one moment touching its highest intraday record. It's backed off of that. BlackRock's Jean Bovin commenting that investors are starting to get more selective, writing, quote, "We think market optimism can persist for now, but stay nimble. We get more active in our long-term portfolios given a greater dispersion of returns." Jean Bovin joins us now. Jean, I'm going to be honest, I look at a day like today and I'm like, okay, the dispersion is NVIDIA and AI stocks, and let's be honest, tech stocks outperforming them all. Can you be an active manager right now and be selective without just outright being overweight AI stocks?
Well, it's part of being selective right now is to be overweight the AI thematic. So this is something we've been, trying to ride for some months now, since, mid last year. I think that continues to be a big, powerful driver. And we're still positive on that space for the time being. But I guess the point we're trying to make as well is that you cannot rely on this to just be a bull, the prelude for a 10-year bull market. So this is going to be a choppy environment eventually. And you need to be ready to pivot at some point. And this week was a testimony to this, right? You got the big tech story playing out, but at the same time, lo and behold, we got a big significant repricing of Fed expectation that has been happening over the last 6 weeks. We now have only 4 cuts being priced in now. The 10 years moving up, as you were mentioning before. So, there's cross current going on. For now, we think, though, the constructive backdrop is pretty solid, and it's across the board.
Yeah, Jean, I have to say, I spoke with your boss, Larry Fink, about a year ago, and he was talking about AI then. I mean, the world was talking about AI then, but it's fair the Research Institute at BlackRock has been writing about the AI theme for a while. And I get a lot of commentary from fund managers who say, I missed the boat. I didn't invest in NVIDIA a couple years ago. It's gained some 200-something%. If you're not already in the AI stock, Jean, am I too late?
I think the AI story, we call that a mega force. So I think this is something that's going to be playing out for the years to come. It's not about just getting in right now. Now, it's going to be evolving. It's not necessarily about 1 or 2 companies. It's about how this now moves to the implementation phase. It's about the healthcare sector that's going to be benefiting from massive implementations from AI. That's for us, like on the horizon, and then it's going to morph into other things over time. So the AI thematic, I think, is a mega force. It's going to be, playing out over the many years to come. Now, it won't be about 1 or 2 stocks for forever. So I think for us, that's what being selective is about. It's about figuring out what's the next phase of this AI, knock-on effect.
Good, because I think we're tired about talking about Mag 7, then Mag 6, then, Mag 1, I guess is where we are now, Jean. Look, it has been a really resilient equity market, but you're talking about this idea that at some point it will turn. It won't be a market that you can just buy the entire thing. What is that turning point? What prompts that breaks some of the widespread resiliency of this equity market?
Yeah, so one of the key themes we have for 2024 is that you need to manage macro risk. It's not an environment where the macro backdrop is going to be your friend and, basically be a tailwind that you can count on over time. We think this is going to be a much more tricky macro environment. Right now, the dominant story is really about hopes of a soft landing. It's about the Fed that's going to be actually cutting rates. I think we're getting close to that point. The next phase later this year will be, I think, a bit more complicated, where we're going to see that even though inflation, in our view, is going to go to 2 and is going to tap 2, it's going to be temporary, and then we're going to see a rebound in inflation later in the year. So to us, like one of the big signposts to watch out for is how the inflation narrative change. And it's not about sticky inflation staying now above 2. So this is where the way the Fed is. That's what the Fed is worried. I think they're going to be comforted in the fact that inflation actually is going to 2. We're going to see things that look like 2%, but it will be temporary. And so and it's later. So for now, we think it's going to take some time before this strong constructive narrative gets disrupted. So there's no point leaning against that. You want to ride that.
So if we see a prints around 2, Jean, and it's kind of a head fake, are you gearing up for Fed hikes down the road then when we get inflation resurging?
I don't think it's about Fed hikes. I think it's about market was expecting more than 6 cuts. Now there are 4. We might get 2 or 3 in the end. So it's about less Fed cuts. It's about a shallow, very muted easing cycle, combined with inflation that surprised on the upside, and that's going to be a bit different. And just the fact that the markets have been pricing out 2 cuts this year so far. We've seen the 10-year starting to move back up to 4.3. So imagine in a world where now we see a bit of inflation rebound, and the 10-year is on average higher than it is right now. Is going to change a bit the lens by which we're looking at risk assets later in the year.
And Jean, I mean, we learned this. We learned that bonds are bad at protecting against equity losses when the reason for those losses is inflation. If you're saying early 2025 or after this year, we are going to face that threat of inflation coming back up, what serves as my protection in my portfolio? What have I learned over the past few years that's going to help me this time around?
Well, I think one thing to this is the opposite of your question, but I think we want to be careful to extrapolate lessons from the many years, the last 20 years, because they were a very peculiar 20-year period where, we've learned lesson like you expect bonds to play the ballast role in the portfolio. And this is not something you should necessarily count on as easily in this environment where if we do get some market adjustment, risk asset sell-off, on the back of inflation being surprising somewhat on the upside. I mean, nothing like huge inflation, but surprising on the upside. Bonds will not be providing as much of a ballast in this environment. And this is where I think you have to fall back on the more nimble, active management of your asset allocation. That's going to be really the only way to navigate that.
Jean, less than a minute here, but you like Japanese equities. They hit a new record high today. How do they keep going? What powers them further?
So, I think this is again, one of the high conviction view we have. This is one place where the macro is your friend. I think there's a pretty constructive backdrop with inflation there being a positive, continues to be, where the BOJ is, in fact, I think, approaching things in a very relaxed, reasonable way, not panicking on inflation. And I think so that is certainly a big part of the story. But it's also important to know that, it is a big yen story when you look at the performance of Japanese equities. But once you take that into account, well, if you look like in a common currency, there has been like a good story in Japanese equities, but it still is not like back to, it's still lagging. U.S. or, you could debate about what relative to Europe. Right. But the point here is I think this has more room to run. And in fact, it's really more about the macro going forward and the corporate reforms that are starting to get traction. And we think will carry support for equities, throughout this year.
Jean, really appreciate your thoughts this morning. That's Jean Bovin of BlackRock. Coming up on the program, Capital One is facing pushback from Capitol Hill.
The pressure to scrutinize it, I think, is very intense. Certainly to draw out the review, I see no reason to think this is going to go through quickly. How it goes in courts is a different question.
Are you really surprised? We'll have the details on Capital One's deal with Discover next. This is Bloomberg.
And so the pressure to scrutinize it, I think, is very intense. Certainly to draw out the review, I see no reason to think this is going to go through quickly. How it goes in courts is a different question, I think. The kind of pro-competitive impact of strengthening Discover as a competitor to Visa and MasterCard is going to be more compelling when it actually goes to litigation, if it does.
Capital One's Discover deal is facing resistance on Capitol Hill. Lawmakers are pushing back on the $35 billion takeover. Senator Hawley, following Senator Elizabeth Warren's lead, taking to social media and writing, quote, "Sounds like the credit card companies are finding another way to screw the American people. This merger should be blocked, and Congress ought to cap credit card rates pronto." Let's now get into this with Bloomberg's Anne-Marie Hordern. So, Anne-Marie, it's not just Senator Warren. It's coming from the other side, too.
It's not. And sometimes in politics, you see interesting people make friendships look across the aisle. You would normally never talk about Senator Warren and Senator Hawley being in the same camp. But when it comes to Capital One and Discover, both of them think that this deal is not good for the American consumer. You heard from Senator Hawley there saying that some of these credit card companies, the rate should be capped. But really what it comes down to is what's the DOJ and the FTC going to do? And what we know from this DOJ and FTC is that they don't really like mega mergers. We've seen that in a number of instances. Most recently, our reporting is that the FTC is prepared to also sue to block the latest Kroger-Albertson deal. So if that can't get through, you have to think it's going to be very challenging for Capital One and Discover to get their deal through, especially on the heels of a 2023 where the Biden administration set a record for breaking up some of these mergers.
Yeah, Anne-Marie, I know literally the first question you asked when this happened was, are regulators, is Congress really going to let this get through? So again, is anyone really surprised with this? Anne-Marie Hordern, thank you so much. Now, we had data crossing the terminal just moments ago. It's U.S. PMIs. Bloomberg's Michael McKee joins us with the details. Hey, Mike, what you looking at?
Well, we're looking at an economy that's still going reasonably well. A little bit of a decline in the S&P Global PMIs for the U.S., but not much. Still in expansion territory, 51.5 for manufacturing. That's good news because it's up a little bit from the 50.7 that we saw the prior month, and manufacturing has been the question mark. Services down a little, 51.3 from 52.5, and the U.S. composite comes in at 51.4 from 52. Nothing to worry about there. Of course, next week we get the ISMs, which matter more to U.S. markets. But in Europe, they care about the PMIs, and it is still a down economy pretty much across the continent. The French and Germans, a lot of 40s there. The Eurozone itself gets a 50 for services, but manufacturing is still depressed. And Dani, just to make you homesick, the UK, a little bit better in services, 54.3, but manufacturing still taking the pipe, as they say.
I don't know if that makes me homesick, because it makes me think maybe it's good that I'm not there. If the economy looks like that in services means maybe there's still inflation. So yeah, Mike, I'm happy to be here in the U.S.
Happy to have you.
Michael McKee, thanks so much. All right, that's the data this morning. Let's look at some of the sector price action and go over to Bloomberg's Abigail Doolittle. Hey, Abby.
Hey, Dani. So not surprisingly, we are seeing very bullish sector composition for the S&P 500 right now, up 1.6%, heading to its best day of the year since November of last year. Not surprisingly, tech, that's the big sector on that NVIDIA blowout quarter and guide, with that stock hitting a new record high, up 3.9%, its best day since May. Now, you can see the other mega cap tech sectors are also higher, including communication services. But if we dig in a little bit more there, we actually have some declines for the likes of T-Mobile, AT&T, and Verizon. This, of course, on the report of AT&T of wireless disruptions across the country. They're happening in New York, Houston, Atlanta, Miami, Chicago, and Dallas. Some of the customer service representatives for AT&T on X said that they had confirmed that there's a quote-unquote active nationwide outage. Now, there are people on X talking about Verizon and T-Mobile problems, but representatives from those companies are saying that there isn't an outage, that there is not a disruption. So it's going to be interesting to see how this story evolves as the day goes on, Dani.
Yeah, it certainly does. I saw even the San Francisco Fire Department tweeting out saying, hey, you can still call 911. Maybe just find a landline somewhere. Abby, thanks so much. Abigail Doolittle. Coming up, we're going to look at the market-moving events you need to watch this week and next. That's up in our trading diary here on Bloomberg. Risk event out of the way for this week. It was NVIDIA earnings, and it turned out not so much as a risk. You got to feel bad for the folks that sold when it was trading around $650. But it is the NASDAQ which carries the mantle. The tide lifting all boats. 2% is where we are on your NASDAQ 100 index this morning. S&P 1.5%. It is tapping a record for an intraday high. Keep an eye on that. But look, it's not equal everywhere. Small caps, those are only up about 0.7%. Okay, let's get your trading diary. What you need to be watching through next week. Existing home sales will come at the top of the hour. Plus, Fed speak from Philip Jefferson, Patrick Harker, Lisa Cook, Neil Kashkari, and Chris Waller. That's throughout the day. Will they continue to push back like the minutes did? Friday, Warner Brothers Discovery, they will report earnings. Saturday, Nikki Haley and Donald Trump face off in the South Carolina GOP primary. And then Tuesday, we have a slew of retail earnings. That includes Macy's, Lowe's, and eBay. Maybe then we'll stop talking about NVIDIA earnings. Until then, that's the countdown to the open. This is Bloomberg.